May I have your attention? Please welcome TechCrunch editor Frédéric Laudenois and Ursheet Parikh, partner Mayfield.
Yes, thank you. Lunch is over. It's time for some recession. This is not the happiest topic we could talk about, probably, but
well, I'm hoping by the end of it, it does become an exciting topic.
All right. Well, let's try to make that happen.
Yeah.
Now, if you haven't been on this stage before, it's Q&A, so it's your questions, and the way we're going to do that is you can scan that QR code, just like the menu at your favorite restaurants, and it'll take you to Slido, where you can ask questions. I'll get those here. If they're good, I'll use them. If they're not, I'll ignore them, but that's up to you. And while you're starting to get going here, start filing some questions, let's talk about the recession. Are we in a recession?
It doesn't matter.
Okay.
Because if you're kind of an entrepreneur, there is this, there's primarily the core thing. The way I think about it is like you look at decisions and you look at like what if you're right and what if you're wrong. And as an entrepreneur, you control a lot of things, and the tail risk is actually one of the biggest risks that is typically there in entrepreneurship. By that, like there's a few things that are outside your control, where like you control what you build, how you spend your money, who you sell to, who you don't sell to, how you sort of create a platform, bring amazing people into it, all of that stuff. But and so my view on it is almost like if there is one, it's good to be prepared. If there isn't one, you're going to go ahead and just accelerate on. So in terms of like and so be it fundraising or how you're recruiting or opportunities, I think it actually provides a lot of opportunities to create breakout companies.
Okay.
And so that I've had that experience with failed companies and breakout companies in two different recessions as a founder.
Right.
So
now, you don't think there's a risk in being maybe a bit too conservative because you're afraid the market will crash on you?
Yeah, so I actually think that being conservative all the time in a recession is actually not the right strategy for every company.
Okay.
So for example, if you can't cut your way to like profitability, right? I mean, the reality is in startups ecosystem, you have to kind of learn and grow. And so the first thing that I usually tend to think about is how much runway do you have, right? How do you, second, if like there's one of the companies I work with which has 3+ years of runway, right? For them, it's actually an opportunity to really double down. Because if they have product market fit, if enough of their salespeople are successful, right? It's not like just one salesperson kind of succeeding and 3 others not. Then that is, and they're not limited by the market, then such a company should actually double down and increase burn and sort of come out stronger onto the other side. The only downside, it kind of comes down to this, right? Which is the primary place where conservative factors show up. And it's kind of funny, what I'm about to say next, I would say the same thing when I was an entrepreneur, but now that I'm a VC, I say the same thing. It tends to get construed differently. So, your interpretation on it. But generally, the point is that any capital you raise in these times, the valuations kind of tend to be different than, say, you were raising last year. So the core question is, if you kind of get diluted, what are you getting? If you get a stronger balance sheet, you can sort of invest to become a category leader, because if you're a category leader, most of the valuations kind of come to you. Or you sort of avoid the tail risk in case there's an Armageddon, right? Or you miss your numbers, right? And your burn rate kind of goes up, whatever may be the factors. So that is where that part of the question tends to be. So the way I rationalized it myself, in 2009, right when General Motors had gone bankrupt and it was right at the bottom of the recession when I kind of started Store Simple, we had raised an $8 million Series A. That $8 million round had happened at like 8.5 pre with a 20% option pool. But we weren't going to go raise less because we wanted to ensure we had not raised for a dead spot. And a lot of the VCs were kind of really upset and were unhappy with the volume of money we were willing to asking for. Because they felt that Series Bs were happening at a pre-money valuation of like 12 or 13 million. So our Series A post was going to be
those numbers have changed these days.
Those numbers have changed these days. Though those very same numbers used to be 50 and 80 just in 2006, right? And so a lot of my view was I don't want to raise money for a dead spot. I'm going to go focus on what I can, which is how do I kind of go ahead and build a big company. And then when it came to Series B, I had, and that was in 2010, and I had my, that spent 2.8 million out of the 8 million raised, and ended up taking another 13 million in a Series B, and that was like a reasonable markup to the round. So the point is that my view was it allowed me to sort of go ahead and really hire the best people, execute and kind of create a category kind of leading company. But these tend to be sort of different companies, different situations, different decisions out on that end.
Talking about different companies, now that's if you have a lot of runway right now, you're okay. What if you don't have that runway right now? What you should you be doing?
Yeah. So if you don't have a lot of runway right now, I think it becomes very helpful to get situationally aware relatively fast. So by that, what I mean is that right now, generally there's a tendency to have the anchoring effect, and the anchoring effect almost always is based on sort of recent experience. And so there's a desire to think about it. And I've had some founders I've worked with whose last round was in 2 years ago. Their revenues have gone up 4x, 5x, and they've done rounds which have not been at valuations that they would like. Right? They've been like not down rounds, but flat rounds and things like that. And what I kind of would tell them is like, you have to think about not the last 2-3 years of history, but the last 10 years of history, right? And the average rounds and the average multiples. If there is a recession, first we know that the financial multiples have corrected reasonably significantly. And what the market hasn't priced in is a recession. So if we have a recession, all we have priced in is simply that money is no longer cheap because you have inflation and hence a higher interest rate. But if there's a recession, there may be something. But independent of that, what it sort of comes down to sort of thinking about is how do you go ahead and understand what is going to be a reasonably fair value for your company. That's what I mean by, and then sort of recognize sort of when are investors willing to have that conversation with you.
Sure.
It's really hard for investors to break, like, if they kind of come across as lowballing you, then, they kind of tend to get a bad name. And so they don't typically have an incentive to do that. An unnamed VC friend of mine is like, I'm just taking most of the summer off. Why? It's like, I don't want to educate how the world has changed. I'll just come back next year when people have kind of figured it out for themselves.
Right.
But I don't think that's necessarily very healthy, right? I mean, I think if you have the right advisors and you can kind of get into that right mindset, and when somebody's willing to engage with you on numbers, it becomes helpful to sort of ask follow-up questions to understand. I think a common mistake that happens at times like this is sort of messing up your cap table with misaligned investors.
Okay.
Right? So you may end up getting somebody who wants a quick exit to somebody who's really focused on wanting you to build a company. Or you take, you're trying to build a company to sort of go towards an exit in whatever 2, 3, 4 years, but you're taking money from a fund who's really thinking about a 7 to 10 year time horizon and like much greater returns and things like that. Or like you end up getting money on terms where it's so bad that it just tells you that this investor is much more about looking out for themselves at the expense of others, rather than when they are involved with you and on the board, they will look after all the stakeholders, right? I think when an investor gets on a board, they can't be on the board representing their personal interest. There's a fiduciary responsibility for a board member to look out for all of the stakeholders in a company.
Sure.
And when you start seeing some of those disconnects, it's as difficult as it is, it's probably better to not sort of take money in those situations.
Right, but difficult choice for a founder who might be thinking, I really need this money right now. If you're in a crunch, you don't necessarily have that luxury, right?
Yeah, no, I've been into the situation where I had a signed term sheet that where even the investor put in a bridge towards the term sheet while they were finishing their diligence, and the market changed. And they basically asked us to keep the bridge and figure out how we were going to go fund ourselves after that, right? And that kind of, so no, I totally get that part of it out.
Sure.
I think the other part is about sort of, in markets like this, people really want to understand as investors, how are you setting yourself up for an up round as the next round, right? A good multiple 2x, 3x, 5x up round as the next round. For that, what milestones are you going to need to achieve? Are you raising enough for that? And then what multiples are you assuming for that next round either, right? Because it won't be the multiples of 2021. Right. They'll be the multiples of 2014, 2013, something like that, or the average of the last 10 years.
So learning from history, right?
Yeah,
there. We've got a ton of really good questions here. Some you've kind of hinted at, but let me pick out some of these here. What advice have you given your portfolio companies lately in terms of capital efficiency? You kind of hinted at some of that, but
Yeah. So I think it kind of comes down to where sort of companies are in terms of their cash runway. For companies that have, product market fit, are sort of showing are seeing an opportunity to truly break out. For them, there is a true opportunity to really invest and sort of double down. For companies that sort of were thinking about sort of rounds, because a lot of the things were happening more sort of preemptively, we are now sort of asking the question, what is the key value inflection milestones, right? Like there's almost like as an entrepreneur, you have to think about, there's two products you sell. One is the product that you build for your end customers. The second product is your stock, where the customer is the investor, right? And so understanding what is the investor thinking about. So an investor is thinking about sort of team risk, market risk, technology risk, sort of competitive risk, leapfrog, all of that stuff like that. And sort of have a framework about what are the things you've proven out at this phase, and what is this next round, and what is the stage it takes you to, and how that sets it up for that long term. Because as entrepreneurs, or especially as a CEO, right, you generally want your company to be going up and to the right. When you sort of have it down, it becomes really hard to regain momentum, especially in a geography like Silicon Valley, where your best team members can kind of just sort of walk out the door. So which is about get razor focused. If you are doing 3, 4, 5 things, pick the only 1 or 2 things that are really going to matter. You can do 10 things one at a time, right? So ensure that you basically sort of are getting to the milestones and then giving yourself 6 to 12 months after that to raise the capital, right? Don't assume that the capital raises will happen sort of immediately.
How do I pick what I focus on though at that point? Because again, I'm kind of in a tough situation there.
Yeah. So I think it's sort of, at the end, the core of a company is build amazing product and sell more of it, right? So it depends on what phase you are. If you are in the kind of category of a company where you have to invest a lot of money to build product, either in deep tech or in hardware, elsewhere, right? Then you're really trying to kind of go ahead and show how you have built this amazing product. And there often it is about how much do I do on the stuff that is going to be valuable 3 years from now versus a year from now. How much do I invest in that versus getting the product validated with key lighthouse customers, right? It's because in times like this, investors are finding so many companies that time itself becomes short. So when you have amazing technology or an amazing product and there's enough validation, so if you're not already in big revenues, if you are at a relatively early stage, who are the big customers, who are your big references, right? Which are the awards you're kind of winning on it, right? So those kind of factors become helpful in sort of getting people's attention, and then you can get the time to kind of go and work through that. If you're about sort of selling product, then it's much more about which strategies are turning out to be more effective that you sort of focus and double down on.
And you've talked about milestones a bit. What's your advice in setting those milestones and picking the right ones?
Yeah. So it does tend to be sort of specific to a company and specific to a sector. If it is in the product sort of side of the house, then it is really about, is there sort of science or tech risk? Then have you sort of built this product? Then does this product attract kind of lighthouse customers, right? Is it kind of scalable? So it's like, how do you kind of create a range of proof points around that? Now, the shipping of the product is just the start of the beta of your sales process. So then you are sort of figuring out, what is your GTM motion? Is it sort of bottoms up, trial led? How much of it is enterprise sales? You have to sort of go down this proverbial sales learning curve, right? So how many salespeople are able to sell the product, right? Like first, how much can you sell without the founders being involved? And how much can you sell without any of the engineers being involved? And how much can you sell, with just the salespeople kind of going and doing it, right? And so it's kind of getting a sense of the maturity. So these all sort of will end up being kind of different factors. Then it's about like, are you in a market which is well understood and known, or are you sort of going to have to create proof points on the scalability of your business model, right? And so sometimes you can have like say $1 million in ARR, but that may come out of like say 50 customers at $20K each, and a reasonable thing that and if that is what the business is going to be at scale, then a VC probably will want to understand, can you have 10,000 of those customers you could be selling to, right? In other words, is the TAM 100,000 accounts, and can you get 10,000 of those to build something meaningful? Versus, do you need to kind of be, if like say you're doing vertical SaaS software, those are ones where if you have 20 customers, with 50K each, even that may not be enough because there's probably only 1,000 named accounts to sell to.
Right.
And so you have to kind of, so it's also the texture of the number, so there's no standard formula per se out on it.
Now you talked about startups narrowing their focus a little bit. Got audience question here is asking, do investors start narrowing their sector focus during a recession? Like especially with respect to early stage investments?
So I think the short answer is yes, because what happens is when you see, when generally first investing, if you put on the investor side on it, is also reasonably emotional, right? Because you kind of, this is a great time to be investing, right? This is like we're busier now than we've kind of ever been, because not just because we're looking at lots of things, but now is genuinely a great time. You can recruit people, you can engage in conversations, right? Like it's versus like when the market is so frothy that when you ask too many questions, people are like, well, we don't have time to answer those, kind of thing. And so you do find that firms do end up having to look at what is the core competencies, right? And what are the areas and sectors that don't seem very kind of viable, and end up sort of picking kind of focus areas. I would say in a time like this, you will find a lot of the geographic focus come back. So what happens is that people kind of go back and look at, where, does this team, or is there a reference point or a recipe or a process or a community around this team that's kind of helped it sort of become successful. And generally people know that for companies that make impact, right, you can do a lot of it generally remote, but you need reasonably deep relationships. And all things being equal, right, dealing with people is easier with people across a distance kind of thing.
Sure.
And so from an investment decisions perspective, generally I've seen in each of the recessions, right, when the market's going great, tech spreads everywhere in the country. Then when things get tough, a lot more of the core centers start having, more, just getting a greater critical mass of investment. And so that would be an example of a place where now VCs who are, much more likely to then be more focused around the geographies than almost the same thing, but, investing at a distance.
Sure. Are there any specific verticals you're looking at specifically right now because of the recession, or?
Oh, no, we are investing out just generally out across the board. So we do, software, consumer and enterprise. We do hardware, we do silicon, we do planet health, we do human health.
And no changes to that because of?
No changes to that. What we do look for is like, are we raising enough? So any new investment that is happening right now, it's also happening with the mindset that the milestones you have to achieve for the follow-on round are higher, which means that we have to go ahead and raise more capital. So we are actually seeing some cases where normally a company would have just diluted 20% from one VC. But the belief is that they need a lot more capital. Instead of 10 million, they need 20 or 25 million to get to that next stage. And inherently doesn't change the current value of the company, but then the teams are choosing to sort of go ahead and dilute more and take that capital to set them up for that strong next stage kind of thing. Yep.
And maybe follow-on questions also from the audience here. A bit more general, but what are some of the industries or sectors that you think people can be successful in right now to become entrepreneurs? Like you talked earlier on about how this is a good time to build a long-lasting company to some degree, right? Are there any specific niches you're?
I think I tend to sort of feel that the smartest people are the ones who are kind of coming in through the door. They're the ones taking the leap as entrepreneurs. And so I think it keeps on coming back down to, right, like what is the amazing product for whom? And how are you going to go ahead and design your business for high operating leverage? In other words, how can you acquire customers in a way that you can kind of scale up? And, one of my sort of anti-portfolio things I would put coming out of the last recession was Zoom. And I was like, hey, WebEx, it's working just fine.
Was it ever working just fine?
Again, right? Clearly, hence it's in the anti-portfolio, right? But I'll tell you, when I kind of put my entrepreneur hat on, the one thing I am really appreciative of is venture capital in quote scales linearly, right? Because you can have the more the firms, the more the opportunities, and at the end of the day, you're going to only have a handful of investors out in your firm,
right.
and I actually think that there is plenty of capital around in the ecosystem. What has changed is people are asking more questions. People are trying to sense whether you're situationally aware. How are you going to partner? Do you have the grit to kind of get it over to the other side, right? Like what is your agility in how you sort of build the company, how you adapt, all of that kind of stuff like that. But I don't think that this world is the Armageddon sort of world. It's far, far, far from it. I mean, I think if we are in like this for another 2 years, then it will be like 2008, 2009, or like 2001, 2002. But I genuinely there's plenty of capital in the ecosystem.
Sure. Are you finding that the founders are ready to answer those questions? Are they thinking about
well, every
the ones
founder,
you're talking to?
Every founder, every company is different. But yes, there's a lot of founders who it kind of comes down to how you sort of start taking the first principles view, also who your sort of advisory kind of network is, who you're talking to. In the last 10 years, right, the world's not seen. Like for me, my first 10 years after my undergrad were very different. Right, graduating in '98, I came to Silicon Valley in '99. Had started a company then, and closed a round. Got us a bunch of customers, raised a Series B, and then that round fell apart and had to kind of go work through layoffs, and a lot of customers went bankrupt, all of that kind of stuff. And then coming out of it, it never felt like a bull market. And then the 2008 crisis happened. And so like between 98 and 2008, I'd seen two of the deepest recessions of American kind of history. And that's in sort of, and the last 15 years have been a far kind of cry, from that. So, it's, as I said, I think, so how do you kind of go ahead and, there's no need to panic. It's not like, the Hitchhiker's Guide to the Galaxy, the first line of the book, right? It's kind of not like that. Don't panic, induced to sort of say panic. It's actually a really good time to be building a company, engaging in conversations. I think the key is not to sort of react emotionally in any of these things. And if people are engaging and willing to give time, really understanding what they're looking for, what do they need, right? Understanding. Generally, what has changed in the venture ecosystem in the last few years is it's often harder for people to be truly honest, because the fear is if I'm truly honest, then I'll give you a good reason to why we are not investing now, but that may not necessarily be the primary reason, because people may take offense, right?
But honest in terms of my motivations, or honest in terms of my financials, like
feedback.
Okay.
Right. So because here's the thing, right? See, every investor conversation you have is very much an opportunity to improve your pitch, right? And kind of see and recognize it, right? Yeah. And I believe that investors spend time with you, they learn about you and your business. You should get something in return, whether they invest or not, right? And that.
Right.
And so I think that, but if people, and so I will usually ask people if they want feedback, and then if they do, then I strive to kind of be as transparent, because my feeling is whether I'm invested with you or not, I'm rooting for your success. As long as your company is not going to harm the world. I believe entrepreneurs change the world, and the large companies are not the ones who are going to go ahead and solve big problems.
Sure. Some investors are fine with startups that try to hurt the world. But got a bunch of questions here. Maybe we can just get through some of these. And a lot of this goes back to funding rounds and kind of the technicalities there. But what should the approach to valuing a Series A startup be these days? What forward revenue multiple should founders and investors be aiming for? It's one of the questions here.
I think I'll answer this question, but not in the frame of reference that's kind of provided here.
Sure.
At the end of the day, investors can only own so much of your company. So if the investor is going to sort of be invested with you on your board in a classic sort of lead seed investor or a lead Series A investor, it's worthwhile for you to understand what their fund model is, right? How much do they invest, for what kind of ownership? Whether that level of capital sets you up to get to sort of the key milestones. And that's invariably how a lot of the valuation numbers end up kind of getting arrived on out on that end, which is kind of different from like, oh, here's a formula, right? At Series A, I need to have 2 million in ARR. I mean, Series A's are happening on PowerPoint even now, right? With first-time founders even now to like, so there is no sort of necessarily fixed formula. It's much more about, the engagement, the interpersonal dynamic. If one thing that I feel becomes is that there's more to your lead investor than just the money that they are kind of giving in, right? And this construct of what is the value that they are adding. Whether you do this or not, I would steadfastly recommend against taking money from anybody on whom you've not done reference checks, right?
Right.
Ask them for reference checks or do back channels, but you want to understand whether it's going to be a fit, how are they going to be aligned, what is this kind of relationship going to be. And then, the early stage investors are used to giving the highest multiples, right? When you invest in a zero revenue company, it's an infinite multiple. And so while the public market multiples, may have gone from 50x trailing to like, whatever, 10x trailing, right? It's coming to Series C, D, B will show up. But the A, depending on what, like during 2021, what was a Series A was really in most, the 2021's top, I would say the top 10% Series A's of 2021 used to be Series B's of like 2018, used to be Series C's of 2016, right? So in valuation, pre-money valuation terms.
We've definitely seen a lot of that. Maybe the wrong question for you, but I'm going to ask it anyway. What about bootstrapped companies?
Amazing. Why not? I mean, see, the thing is the venture funded model is not, there's many ways to build companies, and the venture funded model is one, right? Typically the idea being in that kind of model, the expectation is that, from 7 to 10 years of your sort of first institutional capital in, that you're sort of trying to go and be a multi-billion-dollar company or a $10 billion kind of company. And that has its own sort of momentum, but doesn't have to be that way. So, some of the most amazing companies were bootstrapped for the longest time, right? I don't know if you guys know of a company called Automation Anywhere, right? That company was bootstrapped. When I was an entrepreneur, the CEO, Mihir Shukla, we were in the same sort of CEO coaching group called the Alliance of CEOs. And so, I mean, there's absolutely, if you can at the end of the day, if you are doing a company to make impact, the investor dollars can only take you so far. If you really want to make the impact, your revenue and the gross margins of the business create a way more sustainable sort of way to reinvest in the business for impact.
Sure.
And the venture dollars just have to help you kind of kickstart that effort. But if you can get there with customer dollars, there's a company called Viva Software. I don't know how many people in the audience have heard about her. It's it's worth somewhere between 30 and 50 billion. The stock market's very volatile. That company just did one round of $4 million, right? And never did another round after that. So, yeah.
Sure. Plenty of those around. Now, we're slowly running out of time here, but everybody wants an answer to this question, apparently, according to my iPad here. With the hyperscalers, so AWS, Azure, Google Cloud, growing bigger and bigger and getting into the SaaS space now, how do you think a startup can build a moat there?
Yeah. I think it's one or two categories. Either you basically have, amazing product-led sort of adoption that then kind of drives discovery. And then based on that, you can learn enough about your customers and how to delight them, and then sort of find a way to make enough salespeople successful at scale. Because bottoms up, can take you from 0 to 10, 0 to 20, 50, 100, but like eventually, you do need to sort of go ahead and work through enterprise budgets and kind of go ahead and sell. Or you sort of build a product that is really delightful for a core set of people on a big unmet need, and you really over-service those people, and in a way where you can actually build an enterprise sales motion and make that part of it successful. I think the big hyperscalers themselves are becoming kind of bigger and more bureaucratic, and there's a reason why like every decade you get, and whatever are those dominant companies, like Microsoft is one of the few which has stayed consistent, across the last 3 or 4 decades. Apple disappeared for a while, came back, right? But there's a lot of other big companies, like there was Sun, and for a while Oracle was kind of like that, and EMC. I mean, they're like So I think I wouldn't worry. I'd say I wouldn't be paranoid about that as much as am I really focused and am I really finding fire, right? I mean, you know when you kind of get that product market fit and the repeatability and the scalability of the model and when your salespeople are becoming successful. And you do want to be very tactically focused on numbers, but always have a strategic roadmap in mind, right? Where is your core competency? How are you going to go ahead? And like knowing fully well if something is very easy for a hyperscaler to do as a natural extension, right? How are you kind of going ahead and just presume that they are there. Presume that they are in the room telling your customer they have this on the roadmap. Will the customer still buy your product, right? Your bar on what you really invest in has to be something like that.
All right, 9 seconds left. Last questions. How long do you think the recession will last? You can answer that in one sentence.
Don't know.
Right,
I don't know if we are in one either. So,
Fair enough.
But yeah, plan for 2 years. That's generally the thing, right? Beyond that, we'll see.
Plan for 2 years. We'll talk again here next time about how everything is great and people should plan for the bull market.
Well, you should always plan. There's always a bull market somewhere, right? I think as Jim Cramer says that or something like this. So yeah, and this I mean, again, I'm a big fan of like really doing companies in these times. The entrepreneurs disappear, the real entrepreneurs are there. Frankly, even the investors who are investing at this time are good investors, right? They actually have the stomach for sausage making. They are willing to take risks and leap out on that end, right? There's nothing like a cheap deal in venture, either a good deal or a bad deal, because the way venture firms are set up, distributions almost always get sort of driven. A venture, like an investor can only lose 1x their money in an early stage company, right? They are in it to sort of for their LPs to kind of get much more back on.
Right.
So, yeah.
Those 9 seconds are over. Thank you very much. Thank you all.
Guys.